The president of the United States just fired a Fed governor. Pretty unprecedented move that is likely going to have quite a consequence, quite the ramification on the bond market. And that's what we need to talk about in this update. What is going to happen if and when it seems like Trump wants control over the Fed, wants control over policy, over rate setting policy to bring rates down? What's going to happen if that ends up fully playing out? And what are the ramifications of this move yesterday of the firing of Lisa Cook? That's what we are going to discuss in this update. Get subscribed, turn that notification bell on if you are new here. You don't want to miss any updates going forward, and give this video a like on the way out if you find it helpful. Let's jump into this. I think really that there are kind of two takes that make sense given what we're seeing. And what we're seeing is, again, just to set the stage, Trump fires the Fed governor, is looking to replace essentially the entire Fed board and the chairman with people that are essentially just going to say and go along with what the president wants, which is to bring rates down. So what is the implication of this? Certainly there has been at least precedent to this point that Congress, the president, allow the Federal Reserve, allow the chairman to set rates where they think are necessary to meet their charge of stable employment, stable inflation, and to hit the growth target. And that has always been the Fed's charge. And occasionally there might be some kind of political meddling, but for the most part, the Fed has had their autonomy, and moves like this haven't happened. And it looks like, if what is actually playing out will come to fruition, that now what we're seeing is no longer the Fed have autonomy, but that the setting of interest rates is going to be a political decision, a policy decision, essentially a voting decision, not what the Fed thinks is correct policy based on what their charge is. And so if this ends up playing out and we see this structural change take place in terms of how interest rates get set, that this is now more a voting ballot issue than it is what the Fed thinks is right, then we have two paths from here. I think the most kind of common, the biggest voice out there, the biggest concern is this idea that really what's going to happen is that the fact that the Fed is going to lose autonomy in setting rates is that it's going to just spook the bond market, right? Bonds are going to collapse, where there's going to be a loss of confidence in the bond market, and Armageddon awaits if that plays out. Now, I would agree if bonds collapse and rates went to infinity or whatever, that would be a terrible outcome and would in fact bring Armageddon. But I don't think that's going to happen. And my take is that I think what will happen if, again, this is a big if. I mean, we don't know how exactly everything shakes out from here. But if we are going down the path with it, which it looks like the probability of is higher than ever before, that the Fed is going to lose their autonomy and they're going to start to answer to whether it be the president or Congress or some sort of policymaker for exactly what rates should be. And what I think is going to happen, and the argument that I'm going to make in the rest of this video, is that rates are going to drop to zero. And this is because the Fed, Congress, they are the monopoly price setter of interest rates. So that's going to be my argument for what's going to go on here. So let's kind of build that up in steps here and pieces here to really have this make sense. So step number one is this idea that the Fed is the monopoly price setter of rates in a floating exchange environment, right? So what does that mean, right? In the world of the dollar's not pegged to anything. There's no way for you to take a dollar back to the central bank and say, hey, I want gold, or I want to convert this into another currency at a set value. The value of the dollar relative to other currencies and anything else in the macroeconomy is floating, right? So there is no peg here of the dollar to anything. The U.S. doesn't borrow in other currencies. It is a true floating exchange, true sovereign currency, and that the issuer of the currency itself is the U.S., and it is not beholden to any other macroeconomic policy outside of its own. And that means that rates, even across the entire yield curve, and I'll explain how this happens, are monopoly. They are set by a monopoly price setter. The entire yield curve is set and can be set by fiat, by just saying that the Fed coming in saying, look, we're just going to set rates at a certain rate for infinity, and we will never change it. That's going to be our policy. Congress could come in and say that. They could just get rid of the Fed entirely, and the entire yield curve would have to be at that price because they are the monopoly price setter. They get to say how much interest they're going to give on the bonds that they are going to issue. The counter to that is, well, wait a second, the U.S. has to borrow, and it would be up to the private sector to lend that money out to the government. And so, no, the government is actually beholden to the private sector. Well, that's not the case, because the step that happens first before the lending is the reserve add. The government always adds the reserves into the system first, and then they issue the bonds out after that, and they issue those bonds at whatever rate they set. So the reserves are always there, and there's an institutional structure in place to ensure that those bonds that need to be issued, because various policies, vestigial policies that are still in place, can get issued, and those reserves get absorbed and the bonds head out. It's up to the Fed, up to Congress to determine what that price is that they're going to pay to the private sector once they issue those bonds. Now, with that in mind, we can understand the second point here, which is the yield curve then is a reflection of, since the price setting mechanic is what it is the Fed is going to do based on their models, based on their understanding of what rates should be doing, then the yield curve itself is a reflection of expectations plus premium by market participants based on what future Fed price setting will actually be. So what do I mean by that part? Because it's a bit of a mouthful and a bit hard to track. And I think the best thing to do here is look at a yield curve itself and think this through. What I'm trying to say is the argument that is quite often made is, well, the Fed has control of the short end of the yield curve. And if you're not terribly familiar with what a yield curve is, all this is saying is the Fed issues from 1 month out to 30-year bills to bonds, and each of those issuance goes out at a different yield itself, right? So there's an auction that takes place. The dealers who go to that auction, or heck, you and I can even go to that auction or buy directly from the Treasury, will do so at a specific yield, and those ultimately get auctioned off. So the question that's happening is, or the determination that ultimately sets the price is really market participants are saying, hey, 1 month from now, what is the break-even point of rates that I need to be at to receive some compensation for locking up my money into that bill at that moment in time? And that extends out the entirety of the yield curve. And so what participants are doing as they determine what the proper price is they're saying, hey, 30 years from now, what will the Fed where will rates likely be at that moment in time? What will growth look like? What will inflation look like? What will the policy have to be? And will I be properly compensated with where we think rates are going to be at? And that determines, based on the market trying to guess what the Fed would do on future growth, that is what will ultimately determine what the price is at every point in time on the yield curve relative to that price. And that's why you see, as the yield curve changes over time, it's oftentimes the short end that moves very, very fast, because it's very easy to, or much easier, I should say, to predict what's going to happen next month versus what's going to happen 30 years from now, because no one knows what's going to happen 30 years from now. And so that's why the long end of the curve is very slow to catch up to the short end, and it compresses more over time or accelerates more over time, whereas the short end can happen very, very quickly in terms of its moves, because those moves are immediately impacted by the macroeconomic conditions and the immediate forecast. And that is how then that price transmits throughout the yield curve, right? So essentially it's saying, yeah, there's a monopoly price setter. Let's guess what the monopoly price setter is going to have the price set at any given time over the yield curve. And that's what we're willing to go ahead with a small amount of premium to go ahead and pay for these things. And that is how this kind of dance ends up happening. So the point is, if the Federal Reserve came out like the Bank of Japan came out 30 years ago and said, hey, we're going to set interest rates at zero, and they're going to be at zero forever, you would see the entire curve do something like this. It would compress entirely to zero, right? And that is the big point about the monopoly price setter. If we just came in, let's just say Congress said, we're getting rid of the Fed, and we just want a zero interest rate policy in perpetuity, you would see a yield curve effectively collapse, with maybe the very long end up ever so slightly, just out of the fact that a new new administration could come in, new policymakers could come in and say, nope, we're going to go ahead and reverse course. So that is how you need to understand rates. You need to understand what the Fed and Congress are doing, or Fed, really the Fed, by extension of Congress's kind of abdicating the right to set rates to them. That's how the yield curve ends up playing out. And so let's go back now and think, okay, well, if essentially the presidency now, then the president himself is the one who's going to be setting interest rates, and the president still has 3.5 years left on his term, what does that mean, right? Well, my guess of what would happen is if this, and again, this is a big if we end up seeing this kind of takeover by the president and Congress, this takeover of authority on setting rates, then what I think is going to happen is, at least in the short run, at least on the short end of the yield curve, we should see yields begin to collapse, because essentially what's being said is, and let's just say this is where the 4 year, 3.5 years out is currently at on my little chart here, because at least for the next 3.5 years, interest rate policy is no longer actually in the hand of the Feds. It's in the hand of the president at this point in time. But then after that, we're back up for debate. So to me, that's kind of the first step in thinking about this. But then the second step in thinking about this is, well, wait a second. What we just did is remove autonomy from the Fed for the first time, which means eventually we'll have to give autonomy back to the Fed. And this would be kind of the second step in terms of what happens with yields. And my point here is, look, once the president has power, or if it goes back to Congress or some sort of kind of voting ballot issue, good luck ever finding a candidate or a president who's ever going to campaign or ever going to make the decision to raise interest rates again. So in my eyes, the entire yield curve will collapse if the power to set the rates ends up going back to the president, Congress, or just going to the president or Congress to go ahead and make that decision. Again, if it becomes a political voting ballot box issue, I would suspect that it would be very, very hard to ever get the desire from the private sector, the desire from the electorate to want to go ahead and raise rates ever again. I would, even in the worst of the COVID inflation, I would be hard pressed to think that a candidate for Congress, a candidate for the Senate, a candidate for president would come out and say, hey, man, we really got to raise interest rates here. No one wants higher rates on a mortgage. We all think right in front, what's right in front of us. So I would be very hard pressed to think that under a normal business cycle that we'd really ever see that play out again. So I think what's playing out right now is very interesting. And to be honest, I'm a bit agnostic in terms of what I would want to play out. I think the big takeaway here is, if this does play out, it'll be a very interesting kind of science experiment that we get to see played out in real terms, or in real time, in that we will find out kind of what, MMT 101, what Mosler has been saying is actually true or not for 30, 40 years now, which is a country that has sovereign control over the issuance of its currency and is the monopoly price setter of rates. And if that is true, then we should see that whatever the policy is that's being set by that monopoly price setter should take over. In other words, we shouldn't see the kind of Armageddon play, because it's not up to the actual participants in the market to set the price. It's the monopoly price setter who's going to set the price. And that has always been his big argument. So I think that's what's going to play out. I think that makes the most amount of sense here, with the caveat, with the qualifier, that we're just going to have to see how much control the Trump administration, Trump himself, are going to take over the Fed in the coming weeks and months. So definitely keep an eye out on this point, and I'll revisit it in a couple months when kind of the dust settles from this initial firing. But that's my take right now. But look, before we go, if you are an active investor, active trader, make sure you head on over to appliedmmt.com. Not only do you get analysis just like this every week in extended form in the weekly updates, you also get access to what is probably now more important than ever, the data dashboard, the various models that we have to understand where this macroeconomy is at. We've been absolutely crushing it over there. So head on over there to sign up for the Applied MMT Pro account. But other than that, good trading, everyone. And until next time, follow those flows. Keep following those flows. That is the key. Talk to you next time.